$100 per ounce. A price ceiling that silver has never touched in modern history. Until now. But here's what nobody is talking about. One of the world's largest precious metals dealers just walked away from the table. They stopped buying completely. Not because of profit margins, not because of market volatility, but because of something far more alarming happening beneath the surface of global markets. Something that signals a breakdown most investors aren't even aware of yet. The question isn't why silver hit $100. The question is, what did this dealer see that made them shut their doors at the worst possible time? And what does their silence tell us about what's coming next? Welcome to Boring Currency Index. Now, I know what you're thinking. Boring? Really? But let me tell you something, my friend. The most dangerous financial earthquakes always start with the boring details everyone else ignores. If you've lived long enough to see markets rise and fall, you know that wisdom doesn't come from headlines. It comes from paying attention to the quiet moves, the ones that don't make noise until it's too late. So before we dive deeper into this silver shock, do me a favor, hit that subscribe button. Not for me, but for yourself. Because the insights we share here could be the difference between being prepared and being caught off guard. And tell me, where are you watching this from today? Are you in the States, Europe, Asia, somewhere watching the same global economy we all share? Drop a comment below. I'd genuinely like to know. Now, let's talk about what just happened in the silver market and why it should concern every serious business mind watching this. On a Tuesday morning in early 2025, something happened that shocked the financial world. Silver prices crossed $100 per ounce for the first time in history. Traders stared at their screens in disbelief. News channels scrambled to cover the story. Social media exploded with speculation. But while everyone celebrated the historic milestone, one of the world's largest precious metals dealers made a decision that sent chills down the spines of industry insiders. They stopped buying silver. Completely. This wasn't just any dealer. This was a major player who had been in the business for over 4 decades. They handled millions of ounces every month. They were the backbone of the physical silver market. And they just walked away. No announcements, no press releases. Just a quiet notice to their suppliers. We are no longer purchasing silver at this time. The timing made no sense to outsiders. When prices rise, dealers usually buy more. They make profit on the spread. They capitalize on momentum. They expand inventory. But not this time. Within hours, whispers spread through trading floors in New York, London, and Hong Kong. Something was deeply wrong. Other dealers started making calls. They wanted to know what this major player knew that they didn't. The answers they got were vague and terrifying. Market conditions are unprecedented. Risk management protocols have been triggered. We cannot guarantee delivery timelines. That last phrase caught everyone's attention. Cannot guarantee delivery? In the precious metals world, that's code for something catastrophic. It means the physical metal isn't where it's supposed to be. It means someone made promises they can't keep. Silver had hit $100, yes, but the real story wasn't the price. It was what the price revealed. For months, experts had been tracking something strange. The gap between paper silver and physical silver was widening. Futures contracts were trading at prices that didn't match reality on the ground. Mints were running out of inventory. Refineries had months-long waiting lists. Industrial users were panicking about supply. And now, a major dealer had just confirmed everyone's worst fear. The silver market wasn't just expensive, it was breaking. And when a market this essential breaks, the consequences don't stay contained for long. 3,000 miles beneath the Earth's surface in Peru, a mining engineer named Carlos stood in front of a problem that had no solution. His silver mine had been operating for 30 years. They knew every vein, every deposit, every ounce they could extract. And they were running out. Not just his mine. Mines across Mexico, China, Bolivia, and Australia were hitting the same wall. The easy silver was gone. What remained required digging deeper, spending more, and yielding less. Global silver production had peaked. It was now declining for the first time in decades. But demand was exploding. In a factory in Germany, engineers were installing solar panels at a record pace. Each panel needed silver, lots of it. The renewable energy revolution wasn't just consuming silver, it was devouring it. Electric vehicles needed silver for their circuits. 5G networks needed silver for their infrastructure. Medical devices needed silver for antibacterial properties. Industry alone was consuming more silver than mines could produce. And then came the second wave. In government offices across Washington, Brussels, and Tokyo, a quiet panic was spreading. Central banks had printed more money in 5 years than in the previous 50 combined. Currency values were eroding. Inflation wasn't temporary anymore. It was structural. Pension funds, insurance companies, and sovereign wealth funds started making the same calculation. Paper money was losing its reliability. They needed hard assets, real things, tangible value. Gold was already expensive. Platinum was too rare. Silver became the obvious choice. Billions of dollars began flowing into silver markets. Not from speculators, but from institutions managing trillions in assets. In a London trading room, a portfolio manager named Rebecca reviewed her numbers and felt her stomach drop. Her fund needed to buy 10 million ounces of physical silver for delivery. She called her usual suppliers. None of them could guarantee delivery within 6 months. 6 months. For a metal that used to ship within days. She called another dealer. Same story, then another, and another. The physical silver simply wasn't available at any reasonable price. Meanwhile, on commodity exchanges, traders were still buying and selling paper contracts like nothing was wrong. Millions of ounces changing hands electronically. But when someone actually wanted to take delivery, the metal wasn't there. This was the hidden crisis, a growing gap between what people thought existed and what actually existed. And that major dealer who stopped buying, they saw this gap turning into a canyon. In a private boardroom in Zurich, Michael sat across from his risk management team with a spreadsheet that told a story nobody wanted to believe. Michael had run this precious metals dealership for 23 years. He survived the 2008 financial crisis. He navigated the 2011 silver spike. He weathered every storm the market threw at him. But this time was different. His team had just calculated something alarming. If they continued buying silver at current prices, they would be making promises they couldn't physically keep. The math was brutal. They had customers placing orders for delivery in 3 months. Standard business, normal practice. But their suppliers, the refineries, the mints, the wholesalers, were now quoting delivery times of 8 to 12 months. Michael stared at the numbers. The gap wasn't small, it was a chasm. So what happens? He asked slowly. If silver hits $128 next month and our customers demand their metal? Silence filled the room. His legal counsel spoke first. If we can't deliver, we face breach of contract lawsuits, potentially hundreds of them, simultaneously. His CFO added the next piece. And if we try to buy on the spot market to fulfill those contracts, we'll pay $120 for metal we sold at $100. We'd be losing money on every single transaction. But the worst part wasn't the financial loss. It was the insurance companies. 3 of Michael's underwriters had already sent warning letters. They were watching the silver market closely. If delivery failures became widespread, they would consider it a systemic event. That meant coverage could be denied. Michael would be personally liable for millions, possibly billions, in unfulfilled contracts. Across town, another dealer named Sarah faced the same calculation and made the opposite choice. She decided to keep buying, keep taking orders, keep the business running. The market will stabilize, she told her team confidently. It always does. But 2 weeks later, one of her major suppliers called with devastating news. The refinery had a backlog. They couldn't process her order for 5 months, maybe 6. Sarah had already sold that silver to 12 different customers with delivery dates in 60 days. She hung up the phone and felt the walls closing in. This was the nightmare scenario every dealer feared, being caught in the middle when the music stopped. Michael, meanwhile, had already made his decision. He sent the notice to all suppliers. Effective immediately, his firm would stop purchasing silver. He would fulfill existing obligations with current inventory, nothing more. His colleagues called him paranoid. His competitors called him weak. But Michael had seen something they hadn't. When the dominoes started falling, he didn't want to be standing underneath them. In a corporate office in Singapore, David received an email that made his blood run cold. He was the CFO of a major electronics manufacturer. His company used silver in every product they made. Circuits, switches, connectors, all required silver. The email was from his primary supplier. Due to unprecedented market conditions, we must revise our delivery schedule. Your February order will now ship in August, possibly September. David read it 3 times. His production line needed that silver in 6 weeks, not 6 months. He immediately called 5 other suppliers. 4 didn't answer. The 5th told him prices had doubled since last month, and they still couldn't guarantee delivery. This wasn't just a David problem, this was an industry-wide crisis forming in real time. Across every sector that depended on silver, the same panic was spreading. Solar companies couldn't get materials for panels. Medical device manufacturers faced shortages for antibacterial components. Defense contractors needed silver for specialized electronics, and nobody had answers, but smart business leaders were already moving. In Boston, an investment fund manager named Jennifer made a decision that seemed extreme to her colleagues. She allocated 15% of her portfolio to physical precious metals, not paper contracts, actual metal in secured vaults. You're overreacting, her partner said. Jennifer pulled up the data. When a major dealer stops buying at peak prices, they're not being cautious. They're seeing systemic failure. I'd rather be 6 months early than 1 day late. She was right to worry. Within weeks, 3 smaller dealers announced they were suspending operations. 2 refineries declared force majeure on contracts. A major mint stopped taking new orders entirely. The silver market wasn't just tight, it was seizing up. And the implications went far beyond silver itself. Economists started asking uncomfortable questions. If silver markets are breaking, what about other commodities? What about supply chains that everyone assumed were stable? The dealer who stopped buying had inadvertently revealed something profound. The global economic system was more fragile than anyone wanted to admit. For entrepreneurs and business leaders, the message was clear. Diversification wasn't optional anymore. Supply chain redundancy wasn't wasteful. It was survival. Hard assets weren't old-fashioned. They were insurance. The businesses that would survive the coming turbulence weren't the ones chasing maximum efficiency. They were the ones building maximum resilience. Michael, the dealer who walked away, gave one final interview to a trade publication. "I didn't stop buying because I thought silver would crash," he said quietly. "I stopped buying because I saw what happens when markets lose trust. And once trust is gone, price becomes irrelevant." That statement haunted every serious investor who read it, because deep down, they knew he was right.